Hey guys, welcome back to my YouTube channel. It is week 2 of 2024. So I want to share this video with you guys. In the video, it's a, more of like economic video than it is like a trading video or a prop trading video. But the video is about why I no longer trade equity indexes. And it started with a book I was reading that this book was assigned. It was written in the syllabus for one of my classes in college, and we never read the book in the class. We never used the book. So now that I'm older, I'm actually going through my whole book collection and reading every single book that's there before I keep buying new books. So this book's called Strategy Maps by Robert S. Kaplan and David P. Norton. It was written in '04, and the book has this idea that the book starts off with the idea that more than 75% of the average firm's market value is derived from intangible assets that traditional financial metrics can't measure. And I've always known that some level of this is true, whether it be like when companies get sold at a multiple, and there's certain times where the assets is like far less than what the company traded for, and you try to find ways to account for that. And so this book's arguing that even public companies as well, a lot of their value is really derived from things that they can't measure. And the book is really more about helping you um, understand that concept, but also use it to your benefit and really find ways to improve on intangible assets that you can't really measure. Like, for example, like a CEO's leadership or your employees or your efficiency. And it really gives you a map to lay out a lot of intangible things that drive an enterprise's value. So, pretty good book. It's hard to read. It's a long read. It feels repetitive, but just that one idea alone to me makes this book worth it, because this book was written over almost 20 years ago. And I actually looked at the price to book value of a lot of stocks modern day, and I would say it's the same or even worse than it was in this book in 2004. So, price to book is the ratio that they use to measure the value of assets. They compare it to the company's market price, which is like what the stock's trading for, times all the shares, divide that by the book value of those assets, and that's how you generally would get a price to book ratio. So, a price to book ratio of, let's say, 5 implies that a company is trading for 5 times the value of its assets. And you can generally look this up on Yahoo Finance under the tab that says statistics. It'll go down and show you the price per book. And you can even look at this at the value of the whole enterprise, or even on a per share basis to really figure out, well, how much of the company's share price is based on the value of its assets per shareholder. So PB ratio and why it matters. PB ratio, price per book, matters a lot in the event a company is forced to liquidate and pay back investors. Investors can normally expect to receive little to nothing or pennies on the dollar in the event this happens. And that's normally because investors are really at the back of the line when it comes to getting payouts from a liquidated company. The creditors would get first dibs on that. And it can also signal that if you look at a company's price to book ratio, it can signal that it's a good time to buy a security or that you're taking less risk on a purchase. For me, this was true when I first turned 18. One of the first big trades I ever made was, it was following the financial crisis in 2008, maybe a year or two after that. And I looked at Bank of America one day, and I realized their price per book value was really low, meaning the stock was trading really low compared to other companies at the time, their price to book. So I just figured Bank of America is too big to fail, and with the price per book, like it was like 4, I think, like that. It was really low. I ended up buying the stock, and the stock doubled in a matter of months, like doubled in value from what I bought it at. I thought it was like, oh my god, I'm a genius. So, sometimes it can signal that it's a good time to buy something. And it's also a good way to measure the efficiency of companies in a similar industry. So even with that same example, Bank of America compared to, say, Wells Fargo, like you can compare their price to book ratio and really see from the perspective of managing their assets, who's better at managing their assets or who's getting greater value on their company based on their assets. So, that's it does matter, and you can use it in a real setting or in the real world. But I also believe that price to book does not tell the whole story. And an example I would give you guys is if I have two bank accounts with $100 in each account, and one account earns 2% annually and another earns 5% annually, if I were to sell you these bank accounts, I obviously would charge more for the one that earns 5% than I would for the one that earns 2%, even though both accounts have the same $100 in it. And the question then is, well, how much would each account be worth? And it depends. For one, your evaluation of how much an account that earns $5 a year might be different from what I think as a seller think it should be worth. But generally, if whatever valuation system you use, if we agree on the price, then we agree on the price, right? But there's no exact number for what that account could be worth because it's based on lots of things. It could be based on what else you can invest in to earn that kind of money. It could be based on the value of those other assets. It's based on your opportunity to get into those assets, or also how much risk is like built into this account. Like, is there any chance that the account could be liquidated and you lose all your money, right? Like, these are all things that would factor into the value of these accounts. But generally, the point I'm making is you can't look at assets as the only determinant, or even, like assets is the only determinant of how efficient a company is, because there are plenty of companies that are low on assets but make tremendous amounts of value for shareholders. So then we get to price to earnings ratio and why that matters. So price to earnings ratio is similar in that it's dividing the market value by something else. And in this example, it's dividing the market value of an enterprise and dividing that by its earnings, let's say on an annual basis. So this is focused more on the income a business generates and not the assets a business owns. And I can give you guys some examples of companies or entities with high earnings and low assets. And a great example I could think of is a YouTube channel. I might own a YouTube channel where all I do is make videos talking on PowerPoints I created, and I can make lots of money from ad revenue from YouTube or sponsorship deals or affiliate earnings. And I might own no assets outside of my laptop and a mic I use to make my videos. And the earnings could be far greater than the value of those assets. Same thing for cloud services. Like, let's say I own a company where I own a hard drive on AWS, or I own storage with AWS, and I have movies on that storage, and I charge people $10 a month to watch movies from my storage. And if I'm renting space from AWS to store the movies, I don't own the hard drive or even where it's stored. I just might own rights to the movie for a period of time, which may not really be considered an asset on a financial statement. So, but I can make a lot of money from renting out my access to that movie on my cloud storage. Same thing for like digital media companies in general, where their assets are like, let's say I own an Instagram account and I have 1 million followers, and I sell sponsored posts to companies for $1 million to reach my 1 million followers. Who owns the Instagram account? Is it really an asset? Can I really measure the value of an Instagram account with 1 million followers? And that's why something like PE would make sense, because I'm valuing the company based on, well, what it's actually earning. And it gives an idea also of how many years it would take for the company to generate income equal to market value. So if I have a company that makes $20 a year and the market value is $100, if nothing changes and things stay the same, you can assume that the company would earn $100 in income over 5 years. So I think this tells a better story than price to book for most modern businesses. But it's really important to understand like how we're pricing the securities that we're trading or selling. I also think that there's issues with both of these when it comes to pricing companies or putting a value on it. And I say that the majority of the value of the enterprise is based on the appraisal of intangible assets. And in financial accounting, this is sometimes considered goodwill. It's when the company trades for above its market value of its assets, and they just kind of lump a lot of the value on their goodwill, and that could be the brand or customer service, just things that are hard to measure, intangible assets that are hard to measure. But in the world of trading, you're putting a value on assets that's based on the largely, mostly, the appraisal of intangible assets that are hard to measure. Um, Intangible assets generally are really hard to measure, and the most valuable companies in the world in 2024, um, they're the ones that drive the indexes, like the big Apples of the world, Google, the Facebooks of the world. Those companies make up a large percentage of the value of the indexes, and the most a large part of their own valuation is based on the appraisal of intangible values of their companies. So, like, who are we to say, Apple's PE is high or low? Is it high? Is it low? And I don't think there's really an exact way to say yes or no, because it's based on so many variables of, intangible assets, intangible value. In the past 12 months, Apple stock traded for both 125 and 195, and there's no good way of saying it's worth one or the other. Like, it's based entirely too much, in my opinion, on sentiment and the way we feel about an enterprise's intangible value. A focus on PE focuses way too much on short-term results, which could lead to really ignoring the long-term growth and sustainability of the business, and this could lead to extreme volatility. So, if the majority of the value of the company is based on what it's earning right now, and it has a big miss on earnings, that could significantly change the formula of what the right PE calculation should be. There are some companies trading for, PEs in the dozens, and some companies with the PEs in the hundreds, and that's even assuming the company has earnings. Some companies are not profitable yet, and they're trading at a really, there's no PE because there's no earnings. So a lot of it's based on speculation, really. It's based on what we think is going to happen or what we think something could be worth. But a lot of it's based on feelings and vibes and sentiment, really. And I don't really have a lot of faith in that, personally. I think it forces traders to also have a larger focus on outside forces like monetary policy versus the enterprise's efficiency and operations. You know, the outside forces of like monetary policy, it does have an impact on the value of modern business, and it's a big one. But how do we put an exact price on this value? It's hard. It's based on what people think, and typically, if important enough people think something, then that becomes the reality, and it just feels like largely like a guessing game. So it's hard to measure the value of assets, and especially, or no, the value of enterprises when a large part of the value of the enterprise is based on intangible things, and not just intangible things, but the public's perception of these intangible things, which makes it hard itself. Then there's commodities. Commodities is like corn, soybean, crude oil, things like that, that they trade in the futures markets, but they're a little different than stocks and equities, because there's an actual use in most instances of the commodity. So one feature of commodities is they have buyers and sellers buying for reasons other than price movement or income. Commodities are bought for usage and price speculation. So an example I can give is like corn, the corn market. Let's say I make cereal. I have a cereal company, and I want to lock in the price of corn because I want to forecast my year and what it's going to cost me to create my cereal. So I would, if I want to hedge against the, you know, price of corn increasing, I can go in the market and I could, buy futures for corn. And then when settlement comes, I can either take delivery or I can just sell the contract and pocket the money and then use it to buy the corn in the market to make sure I'm getting it at the price that I felt comfortable buying at, right? So in that example, like I can be in the marketplace trading futures for corn when I actually do use corn. I'm not just buying it to speculate on the price going up and selling it for a profit. I'm actually using it to lock in today's prices on corn. If I think corn is at a fair price for my business to make a profit. So I find from my experience, and I'll use crude oil as an example. This is not like perfect numbers. It's just what I think. But there's a cost to get a barrel of oil from the ground. There's a cost to store that oil, and there's a cost to transport that oil to the end user. But generally, you can add up all of these expenses to get an idea of what the cost basis on a barrel of oil is. And in the global market, the market price will be a closer reflection of supply and demand of all these expenses, right? The cost to get a barrel of oil from the ground, the cost to store the oil, the cost to transport the oil, and even the cost to find, land that has oil under it. Like all these things are baked into the price of a barrel of oil. So there's an idea of what it should cost. And there's lots of data and research in this space that you can really do to figure out these numbers. They're not going to be perfect. They're not going to even be timely a lot of times. It really depends on how much research you're willing to do to find out this price. But everyone has their own idea about how to calculate the intrinsic price. And that's what makes market works. Somehow, it should be someone, but someone has to think it's expensive and someone has to think it's cheap or else no trade would happen. So if I own a security and I'm willing to sell it, I'm selling it because I believe there's a possibility it could fall in value, right? So that's me thinking it's expensive. And for me to find a buyer has to buy it from me thinking it's undervalued and it could go up. If that doesn't happen, we're not going to trade. Um, if I don't believe that my asset could go down in value and it's going to go up, I'm not going to sell it. I'll hold on to it until it goes up in value. And if I don't believe an asset's going to go up in value, I'm not going to buy it. If I think it's going to go down from where it's currently at, I'll just wait till it goes down to buy it. And this difference of opinion is what makes markets possible. I made a chart of the Apple price per book value and the Apple price per EBITDA ratio, and I used the data from Yahoo Finance. And this is based on today, 2024. I think the stats that Yahoo Finance shared was from September of 2023. That's recent enough to give you an idea. But the orange slice in the pie represents the book value of all of Apple's assets. And this is based on them having a price per book of 46, meaning Apple's stock price is 46 times the net value of their assets, like assets minus liabilities. And then their Apple price to EBITDA, which is earnings before interest, taxes, depreciation, it's a little bit higher, which I want to say it was like 1 to 7. So the price is 7 times their earnings. But even with both of these charts, a lot of the value it's far greater than the value of their assets or their earnings. And there's tons of reasons for this. And my concern when it comes to pricing assets like Apple or stocks like securities like Apple is who am I to say Apple is really worth $110 a share versus $300 a share? I think just because of the nature of how we price assets, it could be any of those things on different days of the week. And we see that in markets. You see Apple stock rise from the 120s to almost $200 in a matter of months. And you see it drop from almost $200 to like the 130s or 120s in a matter of months. And I think that level of volatility, and it almost appears for, it's not being driven by Apple's operations or lack of innovation that's making the price go down or up. It's outside forces, and it's often intangible. It's things that are hard to measure, right? And so you're basically guessing on someone else's guess of the impact of some outcome or some intangible asset. And these intangible assets could be their brand, it could be their innovation, it could be markets and lockdowns, it could be monetary supply. But there's a lot that goes into it, and these also affect commodities. I'm not saying it doesn't, but looking at this chart, it just feels like there's a lot of wiggle room in here for the true market value of a security. So when looking at this, it's just really hard to say is if this is an expensive stock or a cheap stock, because I might think it's cheap and it could go up way more than it is now, and I don't think that's a really good way to trade. I really don't. So the fact that companies like Apple and companies that are in the $1 trillion club make up such a large part of indexes, the big ones, I don't feel comfortable trading them or even making a educated guess on the value of these entities that make up these indexes. So this is an article. There's an article from CNN in 2015, and it was an article about the price to produce oil in comparison to the market value of oil. And I love the article because it broke down how it's different prices to produce oil for different markets. And even in some markets, the price to produce oil was greater than the market value of the oil. So in 2015, it cost $52.50 to produce a barrel of oil in the UK, $49 in Brazil, $41 in Canada, and $36 in the United States, while it was $10 for Saudi Arabia and Kuwait, and $10.70 for Iraq. And I thought this was a really cool example. And this is all while oil was trading around $42 a barrel. I'll link the article in the description for the video. But what this basically signaled to me is this is a market, like let's say oil was trading for $60 in the UK. Well, Saudi Arabia and Kuwait and Iraq make a ton of money selling their oil in that market. So at some level, the fact that they were getting oil for $10 a barrel was able to, kind of keep the market from pricing it too high because they would just make the majority of the money. And for some markets like the U.S., I think it costs us $36 to produce oil, and as long as that's below the cost it was trading at, it makes sense. If you're a U.S. producer of oil and you can produce it for lower than it's selling for, then you're gonna do it, and that still makes sense. But this is a market where it just appears that there's market forces and it's driven by like that influence price, and also this ignores the fact that there's OPEC, that they do a lot of I would call it price fixing really in the oil market, but there's forces that drive the price of oil, and a large part of it is based on supply and demand. And yes, there are groups or cartels that manage supply of oil to keep it at certain prices, but even with that constraint, I still think there's like a unit basis of oil that you can reasonably say oil is worth around this much. Like even in this example, we have like 6 different prices. Who's to say oil is worth $42? That's what the market's saying with all the information we had at that time, that this is a fair price of oil. And I think there's more of that in markets for commodities than there are in prices for stocks, where the only buyers of stock securities or indexes really is people that are buying it hoping to sell it for more money later on or to get income from it. Like there's no real way to buy a stock and use it. The only use for a stock is to store value or to get dividends, or to sell it for more money as it appreciates. Whereas with commodities, people are buying it to use it or to sell it. Um, I just think that that dynamic nature of the market where people are buying it for different reasons, I think it makes it easier to get to the true price of an asset or what something should be really worth based on supply and demand. It basically makes it as close to a two-dimensional calculation as possible. Whereas when you're calculating intangible value, you're calculating just lots of different things that impact an enterprise. So for me, I think trading is about the ability of being able to properly price securities, and not necessarily assets, right? Like securities and assets are entirely interchangeable, as I've showed in this video. An examples I could think of is Michael Berry in the early 2000s. He correctly assessed that the housing market was overvalued. So he shorted related securities and profited when the price corrected. Early Apple investors correctly assessed that the company had the leadership and innovation required to increase their value tremendously. Investors that bought early did very well. And this is a great example of just because you're assessing intangible value doesn't mean you're wrong, or it doesn't mean it could be hard, but it still could be done. In the early 2000s, Apple was not nowhere where it was now in terms of innovation and the revenue and their margins and their efficiency. But you might look at Steve Jobs and say, well, I trust this guy and he's gonna go far and he's gonna make $1 trillion company, and just based on his leadership, I'm willing to invest in Apple. And you didn't know how he's gonna do it, you just know he's gonna figure it out. And you might have invested on that and you would have been right. So but the question is, how were you able to assess the value of Steve Jobs' leadership correctly? Like you can't. Like all you can say is, well, the market is undervaluing this guy, so I'm gonna bet on him. I'm gonna bet on his stock. I'm gonna bet on his company. I'm gonna take a risk with Steve Jobs. But there's no easy way to really put a number on the value of Steve Jobs. I think that's just an example of one of the kinds of intangible value that we price into securities and stocks. Generally, if something is priced below what you believe the asset is worth, you would go long. And if the asset's priced above what you believe the asset's worth, you go short. So if too much of the value of a security is based on the perception of intangible value, then it's really difficult in the long term, I believe, to accurately determine a price or to determine if something is overvalued or undervalued. So for me at the moment, I just prefer, I like trading commodities because I feel like there's a greater sense of uh, price being driven by supply and demand outside of other things. If you guys agree with me or disagree with me, I'd love to hear your ideas in the comments. I know this was long winded, but thank you for watching to this far if you did.